There are two methods of preparing a cash flow. We said number one is the indirect method of preparation. Number two is the direct method of preparation. And we did mention that these two methods are the same in all aspects, apart from the operating activities. They only differ in operating activities, where we say that this will use operating, when we are using net income approach, we shall be using what we call the net income approach, or cash received or paid to customers. Therefore, it will only differ in operating activities. And we were doing a question of November 2019, a question of November 2019, question number 4. And in this question, we had already done the operating activities. Therefore, without wasting time, let's go to that question and do investing and financing activities quickly, so that we do also the direct method of presentation. Now, this question, if you are there, November 2019, question number 4, that is the question we were using to discuss group cash flows. And the reason why Mwalimu picked this question is that it has disposal and acquisition of the subsidiary at the same time. Therefore, it helps us to understand either the acquisition of a subsidiary or disposal of a subsidiary in the group cash flows. Therefore, quickly, I will go through the question quickly. November 2019, question number 4. The following financial statement relates to Makongeni Group for the year ended 31st October 2019. We have the balance sheet of 2018 and we have the balance sheet of 2019. Current assets, we have them there, 2018, 2019. Total assets, equity, and liabilities, we have them there. Then we go to a Makongeni Group consolidated statement of comprehensive income and or profit and loss for the year. We have it there. Additional information, note number 1. Additional information, note number 1. During the year, Makongeni Limited acquired 80% of the ordinary share capital of Razaka Limited, paying a cash consideration of 6 million. The non-controlling interest holding was measured at its fair value of 1360 million at the date of acquisition. The fair values of the net assets of Razaka Limited as at the date of acquisition comprise the following. We have the net assets that were acquired. Therefore, it will help us to factor in when we are determining cash received or cash paid at some point. Number 2, during the year, Makongeni Limited also disposed of the entire 60% ordinary shares of Salama Limited. The subsidiary had been acquired several years ago for a cash consideration of 2.4 million. The non-controlling interest holding was measured at its fair value of 1280 million as at the date of acquisition. And the fair value of the Salama Limited's net assets were 2920 million. Goodwill on acquisition of Salama Limited had not suffered any impairment. At the date of disposal, the net assets of Salama Limited had carrying values in the consolidated statement of financial position as set out below. We have property, plant, and equipment, inventories, trade receivables, cash and cash equivalent, then trade payables. Number 3, the short-term investments are readily convertible into known amounts of cash, and there is insignificant risk of their fair value changing. Number 4, depreciation of shillings 1540 million was charged during the year. Land with the carrying amount of 1,000 million was sold for 1,100 million. The gain on disposal was recognized in the operating profit. Some properties were revalued during the year and resulting in a revaluation gain of 800 million being reported. Ignore deferred tax on the revaluation of property, plant, and equipment required examiner wants us to prepare the statement of a consolidated statement of cash flows using the indirect method, but also using the same question, we are going to do the direct method. Using the same question, we shall use the direct method there. Therefore, I believe in this question, we did the operating activities of which we are not going there. We are going straight to investing activities, of which in investing activities we did cash paid to purchase asset, if I remember very well. Therefore, we say cash flow. Our second part of the cash flow, second part of the cash flow, we say cash flow from investing activities. Investing activities, you underline. Remember, you need to underline your work very well. You need to underline your work very well there. You underline your work. This one, we said item number one is, remember we have our currency shillings in millions, but yours is a continuation. We said cash paid to purchase assets, of which we already got. Who can give us the value we got in the cash paid to purchase asset? Who can give us the value we got? Cash paid to purchase asset. 32. Thank you very much. 32. Then we go to cash paid to acquire a subsidiary, of which we have not done. We go to cash paid to purchase intangible assets, and we go to cash received on sale of assets, cash received on sale of a subsidiary, cash received on sale of a subsidiary. Then we also have investment income received, Then we have dividends received from associate, Then we get net cash flow from investing activities. That is our number B, cash received from net cash flow from investing activities. Therefore, we want to look at item number 2. I believe we did item number 1, of which I'm not going back there. We go to item number 2, that is cash paid to acquire a subsidiary. Now, when we go to note number 1, let's go to note number 1 kindly. Let's go to note number 1. It says, during the year, Makongeni Limited acquired 80% of ordinary share capital of Razaka Limited, paying cash consideration of 6 million. Now, we paid 6 million on acquisition of Razaka Limited. But remember, my good friends, this 6 million is not what you report. Listen very carefully. This 6 million is not what you report. What do you report? Net cash paid. Net cash. Let's compute the net cash paid. I said that you leave one page for workings. I believe that's what you are doing. Net cash paid to acquire Razaka. Net cash paid to acquire Razaka. How do we do it? You take the cash paid, which is 6 million in this case. You take the cash paid, which is 6 million. Then you come and less any bank balance, or cash balance in the subsidiary acquired. When you check in the net assets of subsidiary acquired, if there is any bank balance or cash balance, you come to less. Then we come to add. We add bank overdraft. The bank will deal in the subsidiary acquired, then we get the net cash paid. Therefore, it is like this. I will check how much did I pay. Yes, I paid 6 million, but I go in that subsidiary. In that subsidiary, net assets of the subsidiary acquired. Is there any cash I acquired, or is there any bank overdraft I acquired in those net assets? Therefore, like in this case, cash paid was 6 million. Now, let's go to the net assets of Razaka. Net assets. What do we have? Net assets of Razaka. What do we have? When you check in the net assets of Razaka, we have cash and cash equivalent. Therefore, there is cash and cash equivalent of 320. Therefore, here, I'm going to subtract 320. I subtract 320. If there was bank overdraft, I come to add bank overdraft. Therefore, my net cash is 56 what? 5680. That is what I paid, 5680. If you just report 6 million, examiner will not agree with you. And what are you calculating? What are you calculating, Florence? We are calculating cash paid to acquire a subsidiary. Cash paid to acquire a subsidiary. Cash paid to acquire a subsidiary. Therefore, cash paid to acquire a subsidiary, Florence, we were given 6 million. But what Mwalimu is saying, you don't report that 6 million. You check in the net assets of the subsidiary acquired if there is any bank balance in the net assets or if there is any bank overdraft. Why are we subtracting the bank balance and adding the bank overdraft? Remember, I acquired a subsidiary. I paid 6 million. In this hand, I paid 6 million. But in the other hand, this subsidiary came with 320 million. Listen very carefully to what Marim is saying. I know it is very complicated, but you will understand because Marim is explaining. You paid 6 million with one hand, but in the other hand, this subsidiary is coming with 320. Therefore, it means although I paid 6 million, but I'm also receiving some cash. Therefore, I'm reducing on what I paid. But if it was bank overdraft, I'm paying 6 million, then this subsidiary is coming with an overdraft, which means after paying 6 million, I'm also going to pay the bank overdraft. Therefore, it will increase what I paid. Therefore, here we report 56. We report 5680. 5680. We are under investing activities. If you just joined, we already did the operating activities. We are in investing activities. Then we go to the next item, cash paid to purchase intangibles. Now, cash paid to purchase intangibles, you are going to compare intangible assets. Like for example here, cash paid to purchase intangible assets. Here we have 2019, we have 2018. Therefore, I will check in the non-current asset, intangible assets. Intangible assets like patents, for example. Like maybe I have patents or any intangible asset. In the previous year, it was 2,000. In the current year, it is 2,500. Therefore, what is causing the increase? It means that we purchased 500. But in this question, when you check in the net assets, it is not there. It is not there. Therefore, we did not purchase. But my name is just putting there for reference purpose when you are revising, so that in an exam you don't miss marks on it. Then we go to cash received on sale of what? Asset. Cash received on sale of asset, and that we just check in the question, did we sell any asset? Yes. How much did we receive? Like in this question, note number 4, it says depreciation of 1540 million was charged during the year. Plant with the carrying amount of 1,000 million was sold for Kenya shillings 11. Therefore, it means we received 11. I can't just come to report 11 there. It's a cash inflow. It's a cash inflow. It's a cash inflow. We add. Then we go to cash received on sale of a subsidiary. 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 Now, we sold off Salama Limited. We sold off Salama Limited in note number 2, where the examiner says, during the year, Makongeni Limited also disposed of its entire 60% ordinary shareholding in Salama Limited. The subsidiary had been acquired several years ago for a cash consideration of 2.4. When we acquired this company many years ago, that is why we did not put it in our current cash flow, because that was many years ago. We paid many years ago, but disposal was this year. Therefore, we need to know how much do we receive. Now, listen to this. Examiner, in this question, he did not give us how much did we receive on sale of this subsidiary. Listen very carefully, my dear friends. Examiner did not give us how much did we receive on sale of this subsidiary. But what examiner did, when you check in the income statement, he gave us the gain on sale of a subsidiary. The gain on sale of a subsidiary. Therefore, in this question, we are going to use the formula of gain or loss on disposal of a subsidiary. If you are there when you are doing gain or loss on disposal of a subsidiary, then you will help me get this item. How do we get this? You take the cash proceeds, you come to less net assets disposed. Net assets disposed. You also come to less unimpaired goodwill. Unimpaired goodwill. Unimpaired goodwill. If you check where we did this item, you will bear me witness, then you get gain or loss. Gain or loss. I believe we are moving together because we did this item in the disposal of shares in the subsidiary. Now, examiner gave us from the income statement the gain of 400. When you check the income statement, we were given the gain of 400. Are we together there from the income statement? I know you will not say yes, but I believe we are together. Then, for us to get the gain, we need the cash proceeds, we need the net assets, we need the unimpaired goodwill. In Salama Limited, where we computed goodwill in Salama, we computed goodwill in Salama Limited, of which it was 760. Goodwill in Salama Limited, we computed, of which it was 760. When you check where we began this question, goodwill was 760. Therefore, all the goodwill was unimpaired. Therefore, here, on unimpaired goodwill, I put 760. We already computed that. I will not go back there because already we did that. I will not go back there. Then, net assets disposed. Net assets disposed. Net assets disposed. Now, examiner has given us, as at the date of disposal, the net assets of Salama Limited had the carrying values in the consolidated statement of financial position as set out below. We have 39 what? 20. 39, 20. Those are the net assets on disposal. But out of these net assets, we less the NCI. We less the NCI because NCI is not part of us. We less NCI in those net assets. Remember, our target here is to get the cash proceeds. How do we get the cash proceeds? We are using the gain method because if I want the gain, I need cash proceeds. I less the net assets disposed. I less unimpaired goodwill. I get the gain or loss. Now the examiner was challenging to me. He gave me the gain of 400. Also, he gave me goodwill. We computed goodwill. We computed we have the net assets. Net assets is 39 what? 20. Then we check on the value of NCI. The value of NCI at disposal. We want to less the value of NCI at disposal. The value of NCI, value of NCI at disposal. We need to get the value of NCI at disposal, where we are getting the fair value at acquisition, which was 1280. When you check in note number 2, we acquired Salama Limited, NCI is 1280. NCI is 1280. When we acquired Salama Limited, NCI was 1280. Then we come to add post-acquisition profit. We come to add post-acquisition profit. How are we getting post-acquisition profit? I will take 39.20 minus 29.20. Then out of this, I take 40%. I know somebody is saying that's there. Why is Mwalimu taking 39.20, subtracting 29.20? Remember, I want the post-acquisition profit in this question. Listen very carefully. Mwalimu wants what? Post-acquisition profit in a subsidiary disposed. Now, on acquisition of this subsidiary, examiner gave us the net assets of 29.20 on acquisition. At disposal, the net assets are 39.20, which means they increased from 29.20 all the way to 39.20. Therefore, that increase is what we call post-acquisition profit, the increase. Therefore, out of that, NCI share is 40%. Therefore, it comes to 400. Therefore, out of that, the value of NCI is 1680. 1680 is the value of NCI at disposal. Therefore, I come to less it there. 1680. We less 1680 there. When I less 1680, what do I get there? 1680. That is 39.20 minus 1680. I'm getting 2240. Therefore, the net assets disposed is 2240. Examiner was challenging in this question. You listen very carefully. He challenged us somehow. Therefore, in this, I want this one. Therefore, I will work backward. Which means I'm going to take 400, which is the gain, plus the unemployed goodwill, which is 760, plus the net assets, which is 2214. I get 3400. Therefore, this one is 3400. The cash I received on disposal is 3400. The cash I received on disposal is 3400. But remember, although it is the cash I received, but I don't report that 3400. We don't report that 3400. What do we report, my good friends? What do we report? We check in the subsidiary disposed if there is any cash disposed or if there is any bank overdraft disposed. Listen very carefully what Marim is saying. We are going to check in the subsidiary disposed, is there any bank overdraft disposed or any cash balance disposed? Therefore, let's see. Net cash received. Net cash received, I will take cash proceeds. That is the cash received, which is 3400. Then I come to less bank or cash balance. Cash balance will be less. I also come to add bank overdraft in the subsidiary disposed. Therefore, we check in the net assets of the subsidiary disposed, who is very much gracious to Mwalimu here to give him either cash balance or bank overdraft in the net assets of subsidiary disposed. When I check in the net asset of subsidiary disposed, there is cash and cash equivalent of 200. Therefore, I come to less 200. I come to less 200, therefore I get 32. I get 32 there. Why am I lessing cash? Because remember, let me explain something there. Let me explain something. Remember, I sold a subsidiary. I received 3,400. But this subsidiary, on the other hand, went with my 200. It went with my 200. Therefore, it means that I lost. Therefore, I subtract from what I received because I also lost 200. But suppose it was a bank overdraft. I sold a subsidiary, I received that form, and this subsidiary went with my liability. Remember, bank overdraft is a liability. Bank overdraft, I'm not saying bank loan, bank overdraft. Marim has not said bank loan, bank overdraft. That is a cash and cash equivalent. Therefore, it is going with a bank overdraft, which means I'm not going to pay that bank overdraft. Therefore, if it was bank overdraft, I add because it's increasing my cash. But if it was cash, it is going away, therefore you subtract there. Therefore here, I report 32, 3,200 like that, 3,200, 3,200. Where is the 200? Florence, I'm just seeing that you check in the subsidiary disposed. I'm just singing and saying, check with me in the subsidiary disposed. Subsidiary disposed, net assets. If there is any bank overdraft or if there is any cash or bank balance in the subsidiary disposed, you check there. Therefore, if you check there, you will find that there is cash and cash equivalent of what? 200. That is where we are getting 200. Thank you very much. Thank you very much. Now we go to the item of investment income. Investment income. Now, investment income, we check in our income statement. We check in our income statement if there was any investment income and during the year. You check there. You check there. In the income statement, if there is any investment income, there is nothing, therefore I put a dash. Nothing, therefore I put a dash. I put a dash, there is nothing. Then dividend received from associate. Dividend received from associate. Let me show you how you get dividend received from associate. Dividend received from associate. Dividend received from associate. In the dividend received from associate, here, my good friends, what do we do? What do we do? I'm going to take the balance, brought down. This is investment in associate. In associate, investment in associate, balance brought down from the previous year. Investment in associate. If I have it in the balance sheet. Then I come to add profit for the year. Profit for the year, but specifically associates. In associates, I add. Specifically associates, I add. Then also, if there is any comprehensive income. Comprehensive income, but specifically on associates. Specifically on associates. Then whatever I get as my total, I compare with balance carried down. That is the investment in associates. Investment in associates. I come to compare. I come to compare. Then the difference will be dividend received. Dividends received. Now, let's check in the balance sheet. Let's go to the balance sheet kindly together. under non-current assets in the balance sheet, under non-current assets. When you go there, there is investment in associate. Balance previous year, it is 2160. Previous year, 2160. In the current year balance carried down, it is 2480. In the current year, 2480. I'm getting these figures from the balance sheet, non-current assets, investment in associate, because we are looking for dividend received from associate. Then we go to the income statement we take for these two items. Those two items, you get them from the income statement, just like that. When I go to the income statement, I have profit for the year is 460 associate, 460 associate, 460 associate, 460 from the income statement, 460 associate. Then I check if there is any comprehensive income associate. You check under other comprehensive, yes, I can see 200. I can see 200 comprehensive income. Therefore, I make my total there. I make my total that is 2160 plus 460 plus 200. I'm getting 2820. Now, my associate needs to be 28 what? 20, but at the end, the examiner is giving me 24. Therefore, minus 2480. I'm getting 340. Therefore, it means that we received dividend of 340. I come to add there 340. Then I'm done with the investing activities. I'm done with the investing activities. Therefore, I get the net cash, which is 32 plus 5680, 1100, 32. I'm getting net of 4240, but negative 42. Number B is 4240, but negative. That is the net cash flow from investing activities, 4240, but negative. I don't know if you are getting the same. That is what Mwalimu is getting there. Any question, kindly? Any question? Or am I fast? You just say, if you are fast, if you are not getting it, you just say, I'm not getting it, so that we repeat, so that until you get it. Remember, this is not a zero-sum game. This is not a zero-sum game. Let's not just do it for the sake of finishing. We do it for the sake of your understanding. Therefore, it's a non-zero-sum game. Non-zero-sum game, because you need to understand the concept very well. You gain from understanding the concept, as I also gain from teaching you now. Therefore, this is a zero-sum, non-zero-sum. But if it is zero-sum, it means one party is gaining, another party is losing, but it will not help. Is there any question, maybe, any concern, maybe, any comment, maybe, on that? If there is none, we go to cash flow from financing. Cash flow from financing activities. 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 Here we have issue of shares at a premium. Remember, I gave you the format. Marim is just following our format. Therefore, don't say, Marim, where are you getting this? Where are you getting this? I already gave you the format, the preformer on how we prepare this. Therefore, we are just following our preformer, our format. Then we have repayment of loans, additional borrowings. Additional, if we borrowed, additional borrowings. Additional borrowings. We have repayment of loans. of loans. We have dividends paid to parent shareholder. Dividend paid to parent shareholder, then dividend paid to NCI shareholder. Dividend paid to NCI shareholder, then we get what we call net cash flow from financing. Net cash flow from financing activities. Yes, Florence, just say what you wish to tell Mwalimu. What is the figure for cash received on sale of asset? Cash received on sale of asset is 1,100. It's just in the question, Florence. When you read note number 4, we sold the subsidiary, we received 1.1, 1,100. That is what Marim has written here, 1,100. We received 11. The cost was 1,000, but we received 1,100. That is what we received, 1,100. It is just in the question. Okay, let's do the issue of shares. Issue of shares. Now, no, the difference is the gain. Here, Florence, here, it is cash received. Cash received. We did not receive 100. How much do we receive on sale of the asset? When you sell the asset first, you receive the cash, then you calculate the profit. Profit goes in the operating activities. If you check in our operating activities, we say the profit will go there. But here, cash proceeds. Cash you received, the cash. Okay, let's do the issue of shares at a premium. When you check in the balance sheet, under equity, in the balance sheet, under equity, in the balance sheet, under equity. Ordinary shares. From the previous year, it is 6 million. In the current year, it is 6 million. Then what does it mean? We did not issue. But for example, it was 2019, 2018. Ordinary share capital. This is 2,000, or this is 6 million. This is 8 million. What does it mean? It means we issued 2 million. But in this one, it is 6 million, 6 million. Therefore, we did not issue, we put a dash. We put a dash. We go to next item. Additional borrowings or repayment of loans goes hand in hand. Additional borrowings and repayment of loans goes hand in hand. Now, how do we know? We check on loans. Additional borrowing, we check on loans. How do I check on loans? I will take balance, brought down, that is loan, at subsidiary acquired, that is loan from the subsidiary acquired, less subsidiary disposed, that is the loan on subsidiary disposed. Whatever I get, I compare with my balance, carried down, loan. We compare loan. We compare the loan. The difference is what? What additional or repayment. Let me use this question. We go under loans, non-current liabilities. Bank loan, 1,200. This one is 1,200. When we open the year, 1,200. Subsidiary acquired, loan, there is nothing. Subsidiary disposed, loan, there is nothing. In subsidiary disposed, loan, there is nothing. Therefore, our total comes to 1,200. Then 1,200, we compare with the balance carried down, which is 2,000. We compare. As you can see, it is increasing. The Therefore, it's additional borrowing of 800. Therefore, just come here and add 800 like that. Additional borrowing. Therefore, repayment, I put a dash. I did not repay, but I borrowed more. Repayment, I put a dash. Repayment, I put a dash. Ranita. Are we together there? Then we go to the next item, which is dividend paid to parent shareholders. Dividend paid to parent shareholders. Dividend paid to parent shareholders. How do I do that? Dividend paid to parent. How do I get dividend paid to parent shareholders? Here, compare the profits. Compare the profits. You compare the profits, retained earnings to get dividend paid. You compare the profits or retained earnings. How do we compare? I will take my balance brought down, that is the retained earnings, balance brought down. I add profit for the year, your parent. Whatever I get, I compare with balance carried down, retained what? Earnings, retained earnings. We compare with balance carried down, retained what? Earnings. The difference will be dividend. The difference will be dividend. The difference will be dividend. Now let's use this question. We go and in the balance sheet under equity. Under equity, kindly in the balance sheet under equity and liabilities, retained earnings, retained earnings. Previous year, it was 4340. 4340 previous year. Current year, it is 70. 20 current year. Current year, it is 70, 20 current year. Retained earnings. Then we go to profit for the year. And when you are taking profit for the year, listen kindly, listen. When you are taking profit for the year, you don't take total comprehensive. You only take profit for the year attributed to the parent. Profit for the year attributed to the parent, not comprehensive. Comprehensive includes the revaluation, of which we already used the revaluation. Profit for the year attributed to the parent. I believe you are checking the income statement to give me that item. Profit for the year attributed to the parent shareholders. When I check there, we have profit for the year attributed to the owners of the parent, that 180. That 180. Profit for the year attributed to the owners of the parent, which I now take 4340 plus 3180. I get 75. 7520. But at the end, examiner is giving me what? 7020. Therefore, how much did I pay? Oh, 500. 500. I less 500. I less 500 there. I less 500. I less 500. Then we go to the last item. Dividend paid to NCI shareholders. Dividend paid to NCI shareholders. Last item is dividend paid to NCI shareholders. Dividends paid to NCI shareholders. Here, We are going to compare the net assets of NCI. For us to get dividend paid to NCI, we are going to compare the net assets of NCI. How do we compare them? We are going to take balance, brought down, that is NCI net assets. NCI net assets, balance brought down. Then we come to add subsidiary acquired, that is NCI. If I acquire the subsidiary, it will increase the value of NCI. I come to less subsidiary disposed. If I dispose of a subsidiary, it will reduce the value of NCI. Then I come to add profit for the year. Or total comprehensive income. Profit for the year or total comprehensive. Remember here, we are valuing the NCI. Therefore, we are taking everything that belongs to NCI. Therefore, I'm going to take profit for the year, or if I have total comprehensive income, that is what I take, my good friends. Listen, why? Here, when I'm taking profit here up here, it was only profit for the year because we don't pay dividend out of revaluation. But when I come here, for me to get dividend paid to NCI, I'm going to value total NCI. Total NCI. Total NCI. Therefore, if there is profit for the year or total comprehensive income, I take total comprehensive income. But if there's no total comprehensive income, I take profit for the year. Then whatever I get, I compare with balance carried down. This is NCI net assets. We come to compare. Whatever we get as difference is dividend paid to NCI. Dividend paid to NCI. Let's use this question. We go to the balance sheet under equity, non-controlling interest. Previous year is 1280. Previous year 1280. Current year it is 1240. 1240. Current year 1240. 1240. Then I check if I acquired a subsidiary. Yes, in note number 1, we acquired Razaka Limited. What was the NCI? NCI was 1360. We acquired Razaka. NCI was 1360. Note number 1. Note number 1. NCI 1360. Then we disposed of Salama. What was the NCI disposed? We already calculated that as 1680. We already calculated that as 16 what? 80. We calculated that when we are looking for the gain or loss. We calculated NCI at disposal. It was 1680. NCI at disposal. We already calculated that. It was 1680. 1680. We less. Then we check in the income statement if there is profit for the year or total comprehensive income. When I say this, I believe you are going through the income statement to check for those items. In this question, we have profit for the year, 380, but total comprehensive income 480. Therefore, I take 480. I take 480. I take 480. I take 480. That is 1280 plus 1440. 1440. I was supposed to have 1440, but at the end, I have 1240. 200. 200. The difference is 200. Why not taking 380? I'm explaining. I explained and said, remember here we are not taking 380. We take everything that belongs to NCI because here we are valuing NCI. We are valuing NCI, the value, total value of NCI. Therefore, you take everything that belongs to NCI. That is why I'm taking NCI at acquisition. I add the NCI that I acquired. I less NCI that I disposed. Then was there anything that belongs to NCI? Yes, there was profit and also total comprehensive. Remember, total comprehensive is the profit plus the revaluation. Therefore, here we take total. Total. If there was no total comprehensive, then straight you take what? 380. If there was no total comprehensive. But because there is total comprehensive, Marim is saying you take total comprehensive, take it that way. If there is no any other way to explain, take it that way. Take it that way. What Marim is saying, because we are valuing NCI, we are valuing what is the total value of NCI. It is coming to 1440. Then at the end, the examiner is giving us total value of 1240. 1240. Then what is the difference? 200. Therefore, here we have 200, 200 like that, 200 like that. Then you give me net. Net is coming to 100, but positive. Net is coming to 100. Net is coming to 100, but positive. That is net cash flow from financing activities. From financing activities. Then we come to net changes in cash and cash equivalent. Net changes in cash and cash equivalent. Net changes in cash and cash equivalent. This one we take A plus B plus C. A plus B plus C. What was our cash flow from operating activities? What was our cash flow from operating activities? Operating. What was the net? 4420. Thank you very much, Ruth. Be blessed. Be blessed a lot. 4420. I come to subtract minus 4240 plus 100. 280. 280. Net changes in cash and cash equivalent is 280. 280. Net changes in cash and cash equivalent is 280. 280. Out of that 280, I come to add cash and cash equivalent at start. We add cash and cash equivalent at start. Now, this cash and cash equivalent at start, you go to the previous balance sheet, my good friends. You go to the previous balance sheet. Like Mwalimu is going to the previous balance sheet, previous 2018. You check there if there is any bank balance, if there is any short-term investment, and bank overdraft in the previous balance sheet. Like when I check in the previous balance sheet, there is short-term investment of 200 plus bank balance of 360 minus bank OD, minus bank OD. In this question, we do not have bank overdraft. Therefore, here I have 540. I have 540 there. Is it 540 or no? 560, 560, not 540, 560. 560. Then I get cash and cash equivalents. At the end, cash and cash equivalent at the end, of which I go to the current balance sheet, current balance sheet 2019. You check if there's any short-term investment, if there is any bank balance, if there's any bank overdraft in the current balance sheet, current balance sheet. This one we have 300 plus 540 or 560, 540. Therefore, what I get here and what I get here must be the same. What I get here and what I get here must be the same. Let me try. 280 plus 560, 840. Then when I take 300 plus 540, it comes to 840. That is the end of our cash flow using the indirect method. That is the end of our cash flow using the indirect method of presentation. Indirect method of presentation. That is how you present your cash flow using the indirect. As I said in the previous question, the first thing you need in a cash flow is the format. Listen very carefully. If you want to pass cash flow, there is no any other medicine. The first thing is you need the format, because in operating activities, you need to know what items am I going to report. Number two, investing activities, what are the items am I going to report? Number three, financing activities, what are the items am I going to report? Once you know those items, then it is easy to identify marks in a question. Like, for example, issue of shares. You just compare previous and the current, the difference. Additional borrowings, you compare previous and current loans, you get your marks there. I believe we have done justice to this question. We have done every working. Therefore, when you go to revise any question, this question was comprehensive because it had disposal and acquisition at the same time. But the questions you are going to get for revision, it either has only acquisition or disposal. Therefore, there is no subsidiary acquired, subsidiary disposed. It's only one, either subsidiary acquired or subsidiary disposed. Therefore, it becomes very easy. This one was a very comprehensive question, and that is why I picked it for our revision. Therefore, let's have a break of 5 minutes. When we come back, we are going to use the same question to do the direct method. And the direct method, we are only going to do under operating activities. Under operating activities, because we already done the indirect method, we are going to use the same question because you need to get the same answer. Thank you very much. Let's have a break of 5 minutes. Now we continue with our cash flow using the direct method, and we are going to use the same question because we have already read it, and we shall enjoy doing it because we know the figures and we know everything. Direct method. How do you prepare cash flow using direct method? Direct method of presentation. Here, we are going to have cash flow from operating activities as usual. Operating activities as usual. Cash flow from operating activities as usual. Cash flow from operating activities as usual. We have here cash received from customers, cash received from customers for goods, cash received from customers for goods. Then we come to less. Cash paid to suppliers for goods. Cash paid to suppliers for goods. Cash paid to suppliers for goods. Then we also come to less. Cash paid to suppliers and employees for services. For services. For services, like that. Then out of that, we come to less a finance cost paid. Finance cost paid. We also come to less taxation paid. Then we get the net cash flow from operating activities. That's our A, and that's the end of our operating activities under direct method, under direct method, under direct method, under direct method. Now, how do we get cash received? Cash received from customers. Cash received from customers. How do we get cash received from customers? How do we get cash received from customers? Our first item. You prepare what we call receivable control account. Receivable control account. You prepare what we call receivable control account. How do you prepare receivable control account? You are going to take balance brought down, that is receivable. Balance carried down, receivable. We want to prepare our receivable control account there. We want to prepare our receivable control account. Balance brought down, receivable. Balance carried down, receivable. Then what will increase our receivable? Subsidiary acquired, receivable of subsidiary acquired. We add to the opening balance. What else? What else? Credit sales. Credit sales there. Credit sales. Then we come to less subsidiary disposed. That is receivable. Subsidiary disposed, receivable. Then the balancing figure will be the cash received. This is what we are looking for. The balancing figure. Subsidiary acquired. This is the balance brought down, receivable. Subsidiary acquired, receivable. Subsidiary acquired, receivable. Subsidiary acquired, receivable. Subsidiary acquired. Then credit sales. This one is subsidiary disposed. Subsidiary disposed, receivable. Subsidiary disposed, receivable. Then the balancing figure here is the cash we received from customers. Cash we received from customers. Then we go to item number 2, cash paid to suppliers. Suppliers for goods. Cash paid to suppliers for goods. Here we prepare what we call payable control account. We prepare what we call payable control account. Payable control account. Payable control account. Cash paid to suppliers for goods. This item number 2, cash paid to suppliers for goods. We prepare payable control account. How do you prepare a payable control account? Balance, brought down, that is payable. Then balance, carried down, that is payable. Balance carried down, that is payable. Balance carried down, that is payable. Then what will increase my payable? Subsidiary acquired. Subsidiary acquired, payable. Subsidiary acquired, payable. Subsidiary acquired, payable will increase our payable. Then also credit purchases. Credit purchases will increase our payable. If we take goods on credit, it will increase our payable. Then what will reduce our payable? Subsidiary disposed. Payable. Subsidiary disposed, payable. Then the balancing figure here on this account, it is the cash paid. That is what we are looking at. The cash paid, that is what we are looking at. Cash paid, that's what we are looking for. Cash paid to suppliers for goods. For goods. Then we go to the last item, cash paid to suppliers and employees for services. Cash paid to suppliers and employees for services. Cash paid to suppliers and employees for services. Here we prepare what we call expenses control account. Expenses control account. Expenses control account. We prepare what we call expenses control account. Now, in our expenses control account, I'm going to take my selling and distribution expenses from the income statement and distribution. Selling and distribution. I come to add administrative expense. I come to add admin. All this I'm taking from the income statement. Selling and distribution, administrative expense. Then I come to less any non-cash expense included in admin, e.g. amortization, any non-cash expense included in administrative expense, e.g. amortization, any non-cash expense included in administrative expense, e.g. amortization. Then I come to add back any non-cash profit or gain included. I come to add any non-cash profit or gain included in admin expense. Admin expense, I come to add back. Then I get there. That is how we get that item, expenses control account. You take your selling expenses, selling and distribution, you take the administrative expense. Now, why am I saying that? Yes, Florence, also depreciation. That's why I'm just giving an example, because there are many. Even the gain, the loss on sale of assets, there are many. I'm just giving but a few. e.g. amortization, e.g. impairment, e.g. depreciation, e.g. any expense that is non-cash in nature that was included in admin. Even the loss on sale of asset, if it was included in admin, any gain that was included in admin, we add back, because when you included, you subtracted, therefore we add back. And mostly it's admin that is affected, admin and cost of sales. That's why we include those expenses, admin and cost of expense, cost of sales. Therefore, if examiner has not included in the cost of sales that item, it means he has included in admin. Because those items, depreciation, amortization, impairment, mostly the examiner will put it in the cost of sales or admin. Therefore, if the examiner is completely silent, then you are going to adjust from admin expenses. But if the examiner is explicit that it was included in the cost of sales, then you adjust from the cost of sales, not admin. Therefore, that's why I'm just saying any non-cash expense included in admin expense. That is where we report those items. Thank you very much, Florence, for that question. Okay, any other question? Any other question? If there is no question, then we are going to use this same question to do these items. We are going to use this same question to do these items. Same question of November 2019. We are only going to do this part because the rest of the part we already did. The rest of the part we already did. Any question up to that point? Up to that point. If there's no question, then straight we go to the look for the answers. Now, you are going to put this down. We say Makongeni group. You say Makongeni group. Remember, the procedure of the income, the cash flow statement will remain. Those were our workings. Now we go to this question, we say Makongeni group. Makongeni group. Statement of cash flows. Cash flow for the year. And 31st what? October. 31st October 2019. 31st October 2019. That 1st October 2019. Then we come to cash flow from operating activities. You underline using a ruler, shillings in millions, shillings in billions. We want to do it now. Here we come to cash received from customers. Cash received from customers. We are going to prepare what we call receivable control account. Receivable control account. We are going to prepare what we call receivable control account. Let's prepare the receivable control account. Receivable control account. Receivable control account. Now, receivable, I go to balance flow down. From the previous year, my receivable was 1320. I put that at 1320 from my previous balance sheet. Balance carried down. In the current balance sheet, it is 1560. I put it there. Then I check in the subsidiary acquired, sub-acquired. What was the receivable? Sub-acquired. The receivable was 960. 960. Then I come to add credit sales. Now, the tricky part is here. Examiner in the income statement, he just gave us revenue. Remember, revenue and sales and turnover is the same thing. When I say revenue, when I say sales, when I say turnover, it is one and the same thing. When you check in the income statement, we just have revenue. We don't know if it is on credit or on cash. But if the examiner is silent, then all the revenues are on credit. Therefore, I will take revenue of 8360. All the revenues, I assume it's on credit. But if the examiner maybe wanted probably direct method, then he will explicitly tell you that either it is on credit or 3/4 is on credit, half is on credit, like that. Then subsidiary disposed. We disposed of a subsidiary, it went with how much? 480. Then we balance the account. We balance the account. $10,640. $86 cash is 86. I come to report here 86. I come to report there 86. I come to report there 86. Then I come to less cash paid to suppliers. Cash paid to suppliers. Cash paid to suppliers, I go to payable control account. I go to payable control account. Here, I will take balance brought down. Payable. Balance carried down. Payable. From the previous balance sheet, payable is 2,900. Current balance sheet, it is 3,200. Payable control account. Then subsidiary acquired. Payables. We acquired Salama, 880. Subsidiary disposed. Payables. We disposed of 320. Like that. Then credit purchases. Credit purchases. Now, the most difficult part in this method, is how to get credit purchases. Examiner will never give you that. Examiner will never give you that. Therefore, you are going to compute it. You are going to compute it, my good friends. You are going to compute it. How do you compute credit purchases? Remember, here, I want to show you something. When I want to get cost of sales equals to opening stock plus purchases minus closing what? Stock. Therefore, examiner will give you the cost of sales. Examiner will give you the opening inventory. Examiner will give you the closing inventory, but he will deny you this one. That is the most difficult part to do it. the most difficult part to do it. But now, because you are here with me, it will not be difficult again. It will no longer be difficult. It will no longer be difficult because you have me here. Okay, let's do this. Now, we want to get our purchases. Examiner gave us in this question operating expenses. Operating expenses, which equals to opening stock plus P plus closing what? Inventory. In this question, examiner did not give us. Yes, that is the inventory. Inventory. Closing stock is the inventory. Opening stock is the inventory. Inventory in another language, inventory. Therefore, in this question, examiner just gave us operating expenses. Now, operating expenses, for me to get operating expenses equals to, examiner gave me 4620. But this 4620, there is depreciation, which is an non-cash item. Remember, in note number 4, let's go to note number 4 together. All of us, note number 4. Depreciation of 1540 million was charged during the year. Plant with a carrying amount of 1,000 million was sold for the year for 1.1. The gain on disposal was recognized in the operating what? Profit. Therefore, it means that it was included in the operating expenses. Therefore, I come to subtract impairment, loss. Then I add gain on sale of assets. Why am I doing this? I want to get cash operating expenses. Cash operating expenses. Remember, depreciation is an non-cash, impairment is an non-cash, gain on sale of assets is an non-cash. Therefore, my operating expenses, cash operating expenses equals to, I will take 4620 minus 1540 minus 320 impairment. Our impairment was 320 plus 100, that is the gain on sale of the asset. How am I getting 100? It was 1100 minus 1000, we got 100. That's how I'm getting it. Therefore, I want cash operating expenses so that I equate to my formula there. That is what I'm doing there. Therefore, let me see. 46. 2860. That is the operating expenses, which is cash. The operating expenses, which is cash. Now, I will say the operating expenses, which is 2860, which is cash, equals to closing stock, closing inventory. Opening inventory, which was 1740, plus the subsidiary acquired. The inventory of subsidiary acquired, which is 600. I'm adding the inventory of the subsidiary acquired, 600, plus P, purchases, minus closing inventory, which is 1880, minus subsidiary disposed, which is 660. 660. We want to get purchases. I said I want you that this item is very tricky, so that you become very careful on it. I said it is very tricky. But if you follow carefully, you stay with us carefully, you will get it. Therefore, if I want P equals to, I will take 2860 minus 1740 minus 600 plus 1880 plus 660. I get B. Florence, you are lost. Where are you lost? Where are you lost? What are you not getting, Florence? Oh, hapo chini ni wapi, Florence? You just say the item so that we correct quickly, we move on. Hapo chini ni wapi? You just say the item so that we correct it and move on. What is 1740? 1740 is the opening inventory. Inventory in the previous balance sheet. Inventory in the previous balance sheet. 600 is the inventory of the subsidiary acquired. Inventory of the subsidiary acquired. B is our subject matter, which is the purchases. 1880 is the inventory of the current year. Inventory of the current year. Then we less the inventory of the subsidiary disposed. This is the inventory of the subsidiary disposed. I repeat, let me repeat for the sake of Florence. 1740 is the inventory of the previous year, opening stock, opening inventory. We add subsidiary acquired inventory plus P, which is our subject matter, minus closing stock, which is 1880 from the current balance sheet. This one is 660, the subsidiary disposed inventory. You less the subsidiary disposed there. You less the subsidiary disposed there. Then when we do our total, it will be 2860 minus 1740 minus 600 plus 1880 plus 660, 3060. I'm getting 3060. Therefore, my purchases P is 3060. Purchases P is 3060. That is the most tricky part. That is the most tricky part. And I want you that this is very tricky. I want you that this is very tricky so that you become cautious on it. Therefore, my cash paid, cash that we paid is, I will take 29. $68.40. 68.40. $33.20. I'm getting cash paid as $33.20. Therefore, I come to report here $33.20. $33.20. $33.20. $33.20. $33.20. $33.20. Then I come here to less cash paid to suppliers and employees for success, of which, because we don't have those expenses, I put a dash. We don't have those expenses. Those other expenses, we don't have them. Therefore, I put a dash. I put a dash. I put a dash. Now I take 8600 minus 3320, 5280. 5280. Why am I not calculating this? Because we don't have expenses in there. Examiner just gave us total in the operating expenses. We don't have admin, selling, and distribution in this question. I know somebody will ask, why are we not calculating that? It is because examiner just combined cost of sales plus expenses. We don't have admin expenses, distribution expenses, but I gave you how you do it. Now I come to less finance cost paid. Finance cost paid, of course, it was 140. Was it 140? Yes. We already calculated that from the previous question. We already calculated that from the previous question, finance cost paid. Then lastly, taxation, we learned also taxation paid. Taxation paid. Who can give us taxation paid? We already calculated that item. Who is a very good student to give us tax paid from our previous calculation? Tax paid from our previous calculation. What was the tax paid? I don't want to go and calculate it because we did it. Tax paid. 720. Thank you very much, Florence. 720. Then we get net cash flow from operating activities, which is our number A, and it should be the same like what we got in the previous question. It should be the same. Therefore, minus 4420. Our net is 4420. That is what we got, I believe, in our previous. Therefore, that is what you do. That is what you do when you are using the direct method. When you are using the direct method, that is what you do. When you are using the direct method, you prepare receivable control account, payable control account, expenses control account. Of course, these are common. Finance cost and taxation is common. Is common there. Is common. Any question on cash flow? Any question on cash flow? Any question on cash flow? Okay, what I want you to do, I want you to practice. What will it come this sitting? Florence, that is very difficult question for Mwalimu. I cannot answer that. I cannot answer that. It is very difficult for Mwalimu that way because the question is not yet set, and I don't set questions. Therefore, I cannot tell you if it will come or it will not come. But what I assure you is that I have done my part. I have done it. But yours is just to revise and get the concept, because you never know when the examiner will strike. Now, I want you to practice the question of November 2018. Question number, I think 2 or what? November 2018. And November 2018. And let's go November 2018. Question number 4. Question number 4. November 2018, question number 4. November 2018, question number 4. And November 2018, question number 4. Although we are not doing it now, that will be the question for tomorrow at 4 p.m. Tomorrow for 5 p.m. Sorry, tomorrow 5 p.m. That will be the question. We want us to do one question on cash flow, then you will master the concept, then we move on. But when you come in tomorrow's class, make sure you have revised this question, because we shall be going fast. We assume that we know figures. We assume that because I have left the assignment. Therefore, make sure, Florence, when you come tomorrow, you have gone through this question, you have the answers, so that we compare with mine. You compare with mine. You use both methods of indirect method and the direct method. Tomorrow we shall just compare notes. Therefore, we meet tomorrow at 5 p.m. And we look at that last question on the cash flow, so that on Monday we do EPS. But make sure you do your own question, Florence, even though you might not attend, but you make sure that you will revise very well. Thank you for your time. Let's meet tomorrow at 5 p.m.